And we are live. How's it going, friends and family? My name is Amos, and welcome to another episode of the Compounder's Corner. In this video, we'll be going over the companies reporting their earnings this week, and we'll be talking about the stock market in general. If you cannot tell by the tone of my voice, I'll tell you what, it's like the first time in like 3 months, maybe 4 months, where I got at least 6.5 hours of sleep last night. I don't know what it is. But baby girl, let me back it up a little bit. I'm a first-time dad to a baby girl, and she's about to turn 6 months old, and I don't know what it is, but she's sleeping through the night. Oh, God bless her tiny little soul. Because if she has a good night, then everyone else in the house gets a good night, right? And yeah, I'm a stay-at-home dad that does the stock market analysis, research, and all that jazz full-time whenever I'm not taking care of her. So, yeah. Anyways, in case you missed it, videos that were recently uploaded onto the channel this past week, well, we're doing better than usual, right? Sometimes I can't even upload anything, but we did 2 videos. The first one talking about why I'm buying into the sell-off and why I think people that are just super fearful and saying, oh, you're catching a falling knife, why I don't agree with them. And then the other video was about the easiest investing plan in the world with an emphasis on SCHD. Now, with that out of the way, what do we have going on this week? As you can see on your screen right now, there's not a lot of companies reporting their earnings, but we do have Delta Airlines, ticker symbol DAL, and come to find out, the airline stocks, they don't make much money on flights. Right? Because sometimes you'll see a flight going from New Orleans to Detroit and it'll be like half empty, right? But you still got to make that flight and make that jet burn all that fuel. You got to pay for the pilot, the flight attendants, and everything else. Dude, the margins are atrocious. But instead, they make money. Their bread and butter is from their membership fees. The in-flight snacks and beverages that they sell on the cart. You know how they walk around and they'll charge you like $15 for a bag of chips? That's how they make their money. Plus, their exclusive lounges. I'm going to tell you right now, when I used to be a corporate monkey, I used to fly a crap ton, and I had an Amex Platinum card, and I'll tell you this right now, the Centurion Lounge is 100% worth the $500 whatever dollars it used to be when I was a member. I think the price went up, but that lounge, the buffet you can eat before the flight and everything else just to relax and get away from everyone else, I always thought it was worth it. But if you're not flying at least once every week like I was, probably not worth it. But anyways, that's neither here or there. Prior to watching a documentary on YouTube about the airline companies, I always assumed that their business model was all about the tickets that they sold. And then thinking about the CapEx associated with the planes, replacing them and everything else, I didn't really like it. But now I'm opening up to the idea of like, oh, I'm starting to see why a lot of big money investors like airline stocks. So the more you know, as they say. Hopefully you learned something right off the bat right there. And then another company that's reporting their earnings is BlackBerry. I think they made the huge pivot from selling the smartphones from the early 2000s. I think everybody that used to work in corporate America, you had a BlackBerry attached to your waistband. Now, I don't even know if they make phones anymore, but they've made the pivot to being a cybersecurity firm. But to be honest with you, I looked into them for a little bit, maybe like for 30 minutes prior to filming, and I'm like, I wasn't all that impressed. So I'm not going to be paying attention to BlackBerry. I don't care what they say in their earnings. I'm not interested. Okay? But a company on Thursday that's also reporting that's kind of interesting is WD40. Ticker symbol WDFC. It's a boring but beautiful dividend compounder with cheese. Now, WD40, for my friends that don't reside in the United States. I mean, I don't either. I'm a hypocrite. I live here in Japan. But WD-40, it's basically the spray lubricant that you use for almost every maintenance issue with your car, your bicycle, your whatever. Well, not really. It's not a universal maintenance spray, but people use it that way anyways. And the funny thing about this business is, I'm about to blow your mind, okay? They don't have a lot of capital expenditures. They don't have a lot of factories and manufacturing hubs producing their spray. No. Instead, they sell the recipe to third-party players who do all of the heavy lifting. So their business model to me is kind of like McDonald's or Domino's, like a franchise, or even the hotels. We can throw them into this conversation, where the people operating the restaurant or the hotel, they do all of the work, right? Instead, the hotel chain or McDonald's, they get a kickback and a percentage of the sales. And in the case of WD-40, they just sell the recipe. I think it's one of those things where if the economy is thriving, then more people will buy WD-40 because conveyor belts, machinery, and equipment will be full throttle. So definitely a company that I like, but based on all the economic news that's being fed into my brain from all the various websites, it looks like we're going into an economic downturn. So it seems like if you like WD-40, you might as well be a little patient, because I think they have a lot more room to fall in their stock valuation. And I just thought of something else that I wanted to elaborate on. One of the cool things about being a stay-at-home dad is because I spend so much time with my baby daughter, and I also get a lot of time to research, analyze, and learn about what's happening in the market for like 50, 60, 70 hours a week. No joke. It made me a way better investor. Because when I used to work in corporate America, I think I spent maybe like an hour or two reading into what's happening in the markets, but I was always way too busy with my workload to be caught up or to stay up to date on what's going on. So I wasn't as efficient as an investor. But now that I'm spending so much freaking time, honestly, my CAGR has been, I don't want to showboat, I don't want to be too conceited, but I've been very happy. So it's one of those blessings that kind of is awesome. But anyways, other than that, I wanted to circle back on Nike. Remember how we talked about Nike last week? I was like, hey, they're going to report their earnings, and I think it's going to be rough. Well, it was about as ugly as I predicted it to be. I tuned in, and my goodness, was it a disaster. If we zoom back 5 days and just take a look at what happened, I mean, leading up to the earnings, I think the stock market was kind of optimistic because it was going up, I guess, leading in that week. But year to date, oh my gosh, negative 30%. But leading up to that event from Monday to freaking, I don't know, was that like Wednesday or Thursday? They did rise slightly, right? $51 to $53. But after they reported their earnings, my goodness gracious, did they go on a sell-off like beyond belief. A compounder like Nike, they're roughly, what, 40 some dollars a share. We zoom back, they're essentially the same price that they were back in 2014. That's absolutely crazy. But if you were to ask me, I did a technical analysis on them. Based on their indicators, I think their stock price is going to sink towards $30 a share. And I'm going to be completely honest with you. You take a look at their dividend profile, a 3.7% dividend yield. Yes, it's juicy. Yes, the dividend growth rate is good. But the payout ratio, friends and family, I think their dividend, it's in a very dangerous situation. I think it's going to get cut. Their financials look really rough right now. If you take a look at their P&L, their top line, their gross sales has only been decreasing year over year since 2024. You take a look at the profitability of the company. In 2024, it was $3.73, right, for EPS, which is the bottom line per share. It's now $1.51. So the company is struggling. So what was the dividends per share? $1.64, right? So their profits per share is $1.51. So they're paying out more money than they have on hand in order to finance and sustain that dividend payout. And so as a litmus test, I was like, well, hold on. Maybe the cash flow statement will tell us that the free cash flow per share, it's sustainable. Their free cash flow per share is 71 cents. So I don't want to be a doomsday kind of a guy here, a Debbie Downer, a negative Nancy, a grouchy Gary, but this dividend's going to get cut. Mark my words, I could be wrong. They could take on some loans, become more leveraged than they already are. Go to their balance sheet, $8 billion of cash on hand. Okay, because of the $8 billion, they might be able to sustain that dividend for a few more quarters, but total debt, $11.1 billion. What's their debt to EBITDA? Just to take a look at if it's sustainable or not. Their debt to EBITDA is a 3.1, so right around the benchmark, the standard should be. All that to say, I do think their dividend's going to get cut. And when that does happen, right, I think their share price is going to be around $30 to $28. Once the dividend gets cut, I think their stock price is going to soar. Reason being is, I think one of their closest competitors and peers leading up to 2021, because after 2021, once Nike made that hard pivot from being a sports apparel company to being kind of like a Lululemon or an Alo, kind of like a lifestyle clothing company, I don't think Under Armour's a peer or rival to Nike anymore. But anyways, Under Armour, kind of like Nike, right? Their situation in history, a very high peak, and they went on a massive sell-off, actually at their high of 2015, which is sad to say because I'm from the DMV. I refer to it as Nova, Northern Virginia, and Under Armour, based on my understanding, is a company based in Baltimore. So I do want to see companies from my, hometown area to succeed and thrive. But gosh, $51 a share back in 2015. Now they're $5.62. But if you take a look at their performance, I don't know, year to date, 13% into the green. No matter how you spin it. But, prior to their sell-off that started in February, they did go up to $8 a share. They were $4.17 in November, and they shot up to freaking $8.14. So they went up by 100% in their share price alone in a matter of months. But obviously they're selling off because I don't know why they're increasing like that when their fundamentals and financials are absolute trash and booty. But anyways, what I'm trying to say is once Nike cuts their dividend and they become more nimble and they have a lot more cash in order to reinvest into the business to do, because they have this huge turnaround game plan that I'll talk about here in a bit, to allocate that money to brand marketing, because Nike used to be a brand where the story sells, right? Like you'll see someone running 100 miles by wearing Nike, and he did this because he overcame this adversity or this setback or this speed bump, and Nike made him who he is. Just do it. Or you know what I mean? Like that Jordan comeback story. But these days, Nike, they lost their brand and identity. It doesn't resonate with anyone. And even the sneakerheads, they're moving on from Nike. It's crazy to see. But I think once the dividend gets cut, when they're about $28, $29 a share, I'm so sorry, I have ADHD. I think their stock price will see a fat pump. I think they'll go back up to like $35, $36. I get it. Right now, they're $44. But I see them selling off week after week until they hit about 30. And so once they cut the dividend, I think it'll shoot back up to 35, 36. But all that to say, for a long-term hold, I'm not seeing it, guys. Like I talked about it on the channel. I think this is like maybe the 27th time I talked about it. When it comes to apparel retail brands, what's relevant and hot today does not necessarily mean that it's going to be successful tomorrow. Because trends and fads in fashion, they come and go. You look at haircuts, you look at the style of jeans, yes, you look at anything. Just because you were cool today does not mean you're going to be cool tomorrow. Perfect example is like American Eagle, Aeropostale, Abercrombie and Fitch. When I was in high school back in 2006, 2005, whatever, that was what was hot. And then eventually it switched on over to kids wearing pajama pants and sweatpants. And then, the brand Champion, like that became really popular during the pandemic. And now they're nothing. They're irrelevant, right? So all that to say, like, what's cool today, like if you buy into it for a short-term play, obviously, whatever, it's different. But for a buy and hold, to buy into Nike right now as they become more and more irrelevant, it's just, that's not financial advice. It's probably not the wisest use of capital, right? And to make matters worse, their biggest growth driver for the past 5 years, their promise, the what do you call it? The pot of gold at the end of the rainbow, just like Starbucks, was China. And by tuning into the earnings, well, they're anticipating sales in China to decrease by 20%. So even the Chinese don't even want to wear Nike anymore. Nor do the Europeans, not even the Americans want to wear. All I'm trying to say is if less and less people are starting to wear a Nike and it's not a sex symbol and it's not a status or it doesn't have prestige, that's going to manifest on their bottom line, on their P&L, their gross sales. It's going to continue to shrink. And I mean, the proof is in the pudding. If you take a look at their top line, in 2023, it was $51 billion. And since then, it's only been falling. Now it's $46 billion, which is still a lot. This is not a small company. But what's crazy is their market cap is $65 billion, and their revenue is $46 billion. So I think their market cap, so their price to book ratio, soon it's going to be a 1. It's about to be the same, which is kind of crazy. And I don't want to bag too hard on Nike because I used to be invested into them in 2019. If I zoom back and show you what I was looking at, in 2019, I bought them at like, I don't know, we'll just say $80. And when they spiked up to around, I think I sold out of them at like $120. I sold out of them after about a year and a half of holding on to them, and I didn't look back. Because I remember their trading multiple at the time, it jumped up to like a 40 or something like that. And I was like, dude, that's just crazy talk. For Nike? Nah, dude, I'm out of here. And the turnaround game plan. I guess I should talk about that. So right now, obviously, Nike, they're in a very smelly, stinky, hairy situation. And so the CEO, I think his name is Elliot, forget it, can't remember his last name. The game plan is called Win Now. So they're not talking about promises in 5 years from now. They're talking about what are we going to do right now in order to improve our margins and our business operation. And to be honest with you, it's coherent. I think it's sound. Like as a former strategy guy at 2 different Fortune 20 companies, it makes sense. Right? Number one is to return Nike into being who they used to be, their identity resonating with athletes and people that are basketball, football, soccer players, instead of resonating with the middle-aged woman who's just going to put on a pair of Nikes to grab something at Target. Because that's what happened in the past 5 years. They became a lifestyle company, kind of like a Lululemon. And that's not what Nike used to be. Right? So right off the bat, I agree with that. And then number 2, they want to rebuild their relationships with the retailers because during the pandemic, Nike stock price pumped to, I don't know, I guess we could say like 170-ish, 180 because their previous CEO, he had this genius idea of cutting out the middleman and saying, hey, what if we were to just GTM and become a B2C company, just go direct to the consumers. They can order from our website and we'll ship it right to their house. And so they severed their partnerships with Dick's Sporting Goods, Foot Locker, and all the other retail brands. And they were laughing and high-fiving because it showed up on their P&L as a positive thing in the short term. But in the long term, they shot themselves in the foot. Because what happened is when the customers went to Dick's Sporting Goods or to Foot Locker in order to cop the newest pair of Jordans or the newest pair of whatever sneakers that are trending, they didn't carry it. Because Nike was like, nah, dude, we're going to give you the $50 crappy pair of shoes. Y'all can sell that. We're going to reserve the high quality sneaker drops for only exclusively on Nike.com. And as a result, the customers stopped going to Foot Locker and it hurt their numbers. And so what do you think Foot Locker is going to do? When you have your shelf full of shoes from Hoka One One, from Adidas, New Balance, Nike. Do you really think you're going to put Nike front and center when they're only giving you the crappy shoes that nobody else wants? The one that screwed you over in the retail channel. Do you really think they're going to be front and center? No, they put Nike all the way to the back, all the way on the bottom shelf, right? And so now they're having to repair the damage that was done during the pandemic. And then I also think there was one more thing. I think it was something related to the inventory issues, because it's way too bloated right now. They were trying to become a company that did a little bit of everything, and instead they're trying to trim their offerings, accessories, and what it is that they're selling in order to become more efficient. All three of the pillars that they're trying to achieve, I think it's good. And so you might be wondering, do I think Nike's undervalued right now? This is going to be controversial. I don't want to step on any toes, right? Because I know for a fact, some of you watching this video, you're invested into them. And when you're invested into a stock, and whenever I say something negative on this channel, I know you're invested into that company, right? Because you'll leave me a pretty hateful, mean comment. But I'm a data numbers kind of a guy. I don't just invest into a company based on feelings or based on hype or based on the story alone. I need to see the financials, the fundamentals, the data to back it up to say, yes, you are beautiful. That way, if things go south, at least I have a little bit of, margin of safety to know that you're fundamentally sound, and it's just the markets that are being ridiculous with you. But if the numbers look atrocious and it's all based on story, if the story goes south because your numbers are atrocious, the sell-off is going to be astronomical. Now, obviously, there's perfect examples of companies that have really good numbers, but the story is going south, and so their stock price is also selling off beyond belief. Off the top of my head, it's like PayPal, Duolingo, Adobe. So it's not, I guess, how do I phrase this? So it's not going to be always the case, but for the most part, if the numbers are bad and the story goes south, then the sell-off is going to be really, really horrific. But obviously, there are some outlier examples where even though the numbers are good, if the story goes south, the sell-off will also be just as strong. But I don't think Nike's undervalued. Reason being is they're in the business of selling sweaters, socks, shoes, right? Their forward trading multiple is a 27. So based on next year's earnings per share, they're trading at a 27 times that. Friends and family, the S&P 500's median forward trading multiple right now is a 20. So Nike's more expensive than the market as a general rule of thumb. So I think for me, I don't think Nike's an absolute dumpster fire of a company, because when you're generating $46 billion of revenue, you lift open the hood and you realize there's potential here. I think for the past 5 years, they made the wrong strategic decisions, but I think now they're going back into a direction where it makes sense, but it really depends on the customers. If it doesn't resonate with Larry, who's 51, who wore Jordans his entire life, if he does not want to pivot back into Nike, all of this, it won't matter. But I think Nike, that swoosh, their symbol, their logo, gosh, it's crazy for me to say, but I think that is an economic mode, right? And I think they hurt themselves. Their reputation has been damaged, but I do think they can make a comeback. So I think for me, a good entry price would be again, this is going to sound crazy because they're $44 a share, but I would say maybe $23 to $21, and that would imply a 15 PE ratio. But to be honest with you, I'm not adding Nike to my watch list. I'm really not. I'm only talking about them because I know it's a very popular blue chip company, right? And that's because I honestly believe in my heart there's better opportunities in the market right now that trade for a lower PE ratio than a turnaround story in Nike. Because with Nike, I think it's going to be a slow sinking ship, just like Novo Nordisk. That's almost the exact same thing I see happening, right? Like the competition is eating their lunch, and Novo Nordisk and Nike, they're being left in the dust, and their stock price reflects that. So for me, I'm not into it. And to keep you in the loop about the conflict in the Middle East, I'm going to try my best to leave politics out of it, but I hate to say it, but the stock market, there's a lot of external factors that influence the emotions that drive stock prices up or down, and politics is a part of it, okay? If you want to live in a bubble where politics does not influence the stock market, I don't know what to tell you, buddy. That's just not going to be the case. Anyways, apparently, Iran is striking American tech companies that operate in the region. And as of right now, they've destroyed data centers that belong to Amazon and Oracle. And apparently, they published a list of tech companies that they're going after next. So, yeah. And the oil situation that we talked about a few weeks ago when this whole debacle started, I told you guys, the supply chain implications from it, it's going to hurt us a lot, right? Well, anyways, the oil situation's only getting worse and worse. So I can imagine that the price that you pay at the gas pump, you better prepare your butthole, because it's going to get a lot worse. It's going to get really ugly. But so will almost everything else that you buy on Amazon.com, at the grocery store, at Costco, everything, the prices are going to go up, which means inflation is here to stay. And because of that, it's making me think a lot about my current positions. And the reason why I made that huge speech about politics is because that's one of the primary reasons as to why I put so much of my capital into defense companies. The military-industrial complex, the writing was on the wall. The current administration, they were going to go balls deep into funding for military ventures. That's one aspect of how politics influenced a sector or industry. But anyways, I think the ramifications of all of this, the supply chain issues with the oil shortage and the Strait of Hormuz and all of that, I don't think we're really going to feel it until about 4 to 6 months down the road. I think right now we're feeling the immediate spikes, right? But just you wait. When it comes time for Christmas and the holiday season down the road, almost everything that you were eyeballing, looking to gift that special someone in your life, the price tag's about to go up. I am telling you, I'm not a genie in a bottle, but it's simple economics, right? If the price of fuel, oil, gas goes up, so will the transportation costs of moving everything around the world. And if the prices of that go up, you're not going to sell at a loss, right? You're going to drive up the prices of everything in order to walk away with profit. And so as the consumers, we're going to have to eat that, right? And I think the average the price of a gallon of gas in the US, I think it's $5. Don't be surprised if it goes up to $6, $7, $8, right? And I feel for you guys, because even here in Japan, dude, I don't have a car. My wife does. I use a bicycle to get around town. But it's one of those things where it's like, if you've been looking for an excuse to get into shape, this might be it, right? Get a bicycle off of Craigslist or Facebook Marketplace and start riding around town. Commute to work. I don't care if it's 20 miles. Commute to work on your little bicycle. You'll show up super sweaty and smelly, and maybe your coworkers will leave you alone, right? But anyways, I don't know if this is kosher, but thinking about all of this, obviously oil, it's too late. Okay, I told you guys like 2-3 weeks ago, at the top of oil, I said if I invest into oil, I'd be looking to sell right now, because I think the top is in, and I think it's going to be very volatile for the next, whatever timeline. So oil, out of the question. Military stocks, out of the question. They're both very overvalued. But right now, what I'm eyeballing, it almost makes me very bullish. It's the cybersecurity players. Because think about it. I think every S&P 500 company, they're going to be ramping up their defense in terms of securing their data, their servers, and everything else. And right now, my exposure to cybersecurity is only with Microsoft and their security stack, which includes Windows Defender, Security Copilot, Microsoft Sentinel, and I just don't know if that's enough. So for this upcoming week, that's the research I'm going to be doing to see which cybersecurity stock is still undervalued, but also is a tier 2 or tier 3 on my SaaS landscape breakdown. Because I don't want to just jump into cybersecurity if it's overvalued, right? I need to find one that's really relevant, that is going to see their numbers be artificially pumped in the short term because of the Middle East conflict, but also I don't think any of them pay a dividend, unfortunately. Because I did a brief, I guess, recon of cybersecurity stocks about a month ago, and I don't think any of them are dividend payers, but a lot of them are unprofitable. So on paper, they're losing money and burning cash in order to keep the lights on. So that is something that kind of sucks. But I think cybersecurity is kind of the next sector that I'm going to be looking at. But that's just me. I'm not trying to tell anyone else what to do. That's just what I'm looking at. And if nothing checks out and everything's overvalued, I'll just continue to double down on Microsoft. And I really have been. I literally have been buying a share of Microsoft almost every day. Because I truly don't know when the bottom's going to be, right? And I think the market has shown us hints of the rally that's to come once this entire conflict is over. But like I said, 4 to 6 months down the road, we're going to feel some pain. So even though the market's going to rally once this whole thing is over, I think, anyways, that's too negative. We'll cross that bridge once we come to it. Other than that, I have a major announcement to share with y'all later on in the week. Maybe in 2 weeks, it really depends, because it hasn't really hit me yet, right? I haven't really digested it. So once I've had time to process everything, I'll talk about it more. It's scary and exciting at the same time. So it is what it is. And if you made it to the end of the video, I love you guys. Good luck in the stock market. Stay safe. There's a lot of crazy people out here. Just be careful. Don't get road rage. There's a lot of crazies that are carrying a firearm on the highway. You never know who has a screw loose in their head. Just be the bigger person. I'm telling you right now, there's crazies out here. So stay safe, and I'll talk to you guys really soon.